SGB account as well, section. Yeah. So it is always advisable to keeping view of your investment horizon, your risk profile, and other factors before choosing an NPS account. So we always advise you to take the help of a financial professional before choosing an NPS account. So let's move to the second question. Is SGBs really worth an investment? Yeah. So sovereign gold bonds, SGBs. So they are debt instruments issued by the government of India. So these are denominated in grams of gold, and these are very relevant. These are relatively very safe investments because they are backed by the government. So SGBs are more suitable for clients who wants to diversify their portfolio into a low risk investment option. Along with, however, there is need for capital appreciation as well. And as we all know, gold is a safe haven asset, and it acts as a hedge against inflation as well. The good part of SGB is that it offers a fixed 2.5% per annum interest rate from Government of India, which is so that means it becomes sovereign guaranteed. Liquidity. So we need to understand the liquidity part of SGBs as well, because these bonds are locked in for 8 years. So there is very little secondary market as well for SGBs, but the lock-in period is 8 years. And then transparency. So these are the schedules are released by the government of the interest payout and everything. So there is a good amount of transparency associated with the SGBs. Tenure. As I have mentioned, so the lock-in period for the SGBs is 8 years. Taxation. Another good part of the SGBs is that it offers us tax-free capital gains. So after 8 years, when you are actually redeeming the bonds, the capital gains are tax-free. The caution that needs to be keeping in view is that so the value of the investment assets changes along with the changes in the price of underlying gold. So it is always advisable to talk to a financial professional before taking any decision on buying the SGBs. Yeah. So let's just move to the third question. What is the percentage of allocation one can give towards equity during retirement? Okay. So there is no one answer, because there is no one answer fits all to this, because every person has a different circumstances. So it depends on very much the different types of factors, including your age, risk tolerance, your financial goals, and other assets as well. So the appropriate allocation to equities, there is no fixed thumb rule for this, but it is generally advised to go in a conservative approach when you are arriving when you are reaching your retirement stage. That means, so we are advising you to reduce the uh, percentage of allocation of your portfolio towards equity as you are as you are nearing to your retirement. So again, it is always advised to talk to a financial professional before taking any decision towards retirement or towards your portfolio allocation as well. So now we will be moving towards fourth question. So what are the key factors to be checked before buying a health insurance? Yes. So when you are actually buying a health insurance, so there are so many of so many things that need to be considered before taking them. The first one being coverage. So you have to check whether the illnesses and procedures that are available under the coverage are suitable for your family and yourself. So and then premiums. So you also need to consider if you will be able to afford premiums for a longer period of time. Lesser premiums may sometimes mean less comprehensive coverage as well. So you need to do your analysis on this. Deductibles. So deductibles is the out of pocket payment that we will be doing when we are actually claiming the policy. So your high deductible obviously means that your premium is going to be less, but you need to take care of how much out of pocket expenses that you will be able to afford when you are actually using the policy. Background of the company. So you also need to check what is the background of the company, what is its history, and what is the management and everything. All these things are needed to be considered before choosing a health insurance from a particular company. Claim ratio. Claim ratio says that, for example, out of 100 claims, how much and how many claims is the company successfully settled. So claim ratio tells a lot about a company and their customer service. Then the customer service. So you also need to check whether the company has a good track record of customer service, whether they are actually responding to your claims and queries, and etc. So this also plays an important role in choosing a health insurance. And then renewability. So renewability, you need to check if the policy is renewable at all, and if it is, under what circumstances as well. Okay, so sometimes a policy may not be may not be renewable if you develop a pre-existing illness. So yeah, so you need to take all these things into consideration before choosing a health insurance policy. So it's always advisable to talk to a financial professional or an insurance broker before taking a policy. Yeah. Yeah. The next question is there any restriction on senior citizen savings schemes? So we will have a broad look onto this scheme, and then we can go into it. So this scheme is a saving scheme that is designed specifically for people who are 60 years of age or older. So there are few key restrictions on this scheme. So age, you can only be able to access to this scheme if you are above 60, if you are 60 or above of age. Investment limit. So there is an investment limit of 15 lakhs. Only that amount can be invested to this scheme. Taxation. So the interest that you are getting paid for investing into this scheme is actually taxable at your slab rate. Maturity. So this scheme is valid for 5 years, and then you can extend it for 3 more years in a block of 3 years. Yeah. Then withdrawal. So early withdrawal is actually allowed after 1 year into the scheme, but they are associated with high penalties as well. So you need to take into consideration that what are these restrictions as well. And then interest rates. So recently Government of India has hiked the interest rates of this scheme. So people who are invested into January-March quarter of this annum, so they will be getting an interest rate of 8%. So all these restrictions and upper limits you need to take into consideration before actually choosing choosing to invest into this scheme. So I will hand it over to my colleague Sridhar. He will be taking on to the further questions. Thank you so much.
Yeah, thank you, Ganga. Thank you for your insights on personal finance. It was very helpful. So, hi everyone, myself Sridhar. So, I'll be handling the research-oriented part on other equities and other questions which were asked from our customers. So, the first question is like, is FDs, fixed deposits, are safe when put in small finance banks? So, FDs are considered to be one of the safe instruments, as we'll be parking a principal or the capital into a bank, and the bank gives the interest on an annual basis or semi-annually basis or quarterly basis. But we have to remember one thing here, that as per RBI guidelines, the maximum refund repaid to the investors is 5 lakhs per individual, irrespective of the amount held in savings accounts or deposits accounts. So the insurance of 5 lakhs is basically governed by Deposit Insurance and Credit Guarantee Corporation. So irrespective of the bank, the maximum amount which it is given back to the investor in case of any default by the banks or something like that is 5 lakhs. Coming to small finance bank, basically they are new generation banks which are more actively participating in the rural and tier 2, tier 3 cities. So where the financial inclusion is very less. So these kind of these kind of banks serve these particular segments. And also, small finance banks are regulated by RBIs, and a small finance bank should maintain statutory liquidity ratio and cash reserve ratio, just like other banks, which for SFBs, the small finance bank, it is up to 22.25% of the deposits. And also capital adequacy ratio, 15% needs to be maintained. And also there's one more restriction with respect to the small finance banks, that they are not able to lend, they shouldn't lend more than 10% of the capital to any single borrower, which is again taken from a safety and capital perspective. So hence FDs which are kept in small finance bank are pretty safe, and we can go, but the only point we need to remember is about the 5 lakh cap ratio. So coming to the next question, do you think banking and financial sector will have an impact if fund flows into mutual funds? That's actually a very good question from one of our clients. So we'll start with the first point here. So as you can see, banking is the core financial system of any countries. So without banking, there would be very hard and difficulty in financial transactions between the companies or individuals and other persons. But one thing we need to remember here is, so mutual funds investments or capital market investments are from investing point of time. So an investing product which bank provides simultaneously is nothing but fixed deposits or RDs. So there may be some pressure in those fields, which you can see from the graph. So from FY 2018 to FY 22, the fixed deposit ratio, which is in the orange color bank deposits, are reducing significantly, and it has been transferring to other investment assets. So from that point of view, there might be pressure in the investing side for the banks. But again, we also should remember that FD to capital participation ratio in India is very low when compared to other developed nations such as US, Europe. So the retail participation in Indian capital markets are still lower side. So again, the major of the funds will still stay in FDs or RDs, because more of the people are less into the financial markets. And also, banking is the base for the transactions in the capital market. So without a base, we cannot transfer our funds and other things. And also, banks own subsidiaries such as mutual fund companies, so indirectly they get benefited from this. And also, when quantitative easing happenings, that is printing of new money government, the first funds will flow into the banks and they distribute it for the loan distribution and other capital investments, etc. So hence, according to me, there won't be much impact on the mutual fund industries if the flow of money goes into the mutual funds. So looking at the next question, so what is the outlook on interest rate hikes? So this is again a current and relevant question which most of the people are aware of. So as we can see, last year 2022 was a year where COVID, 2021-2022 was a year of where COVID and Russia-Ukraine war was aggravated. Due to this, there was higher inflation in the economy. So inflations have increased up to 8 to 10% in US and other countries, which can be seen in the data below. Also, governments uses interest rates hike to reduce the inflation in the economy. This figure, we can see that Fed has consistently increased its interest rate hike since last year. Currently, the US Fed has a percentage of 4 to 4.5% from zero, which in the recent quarter, in the recent December Fed meeting also, they have increased again 50 basis points. When it comes to India, the Indian banks, that is our RBI, hasn't equally raised with the expectation with US. So our interest rates are much more increased in a slower pace. So this will have a negative impact on the economy. The reason is, we as Indians are the net importers of crude. So we buy crude oil using dollars. And because there is increased depreciation of rupees, so this will hurt our Indian economy, and flow of foreign institutional investors from Indian markets will move out to a safer instruments such as US or other countries. So this might hurt the foreign flows and foreign reserves from India. And also 2023 outlook, the first half as per Fed would be again a hawkish and a pretty slow down economy, but they are expecting that after the second half of 2021 there might be recovery in the economy, and Fed might slow down the interest rates accordingly. And also there are many other factors which depends for this outlook, such as the GDP growth rate, the corporate earnings, employment figures, etc. So considering all these factors, the first half would be a bit hawkish, and hopefully the second half should be recovering. Coming to the next question, What are some of the ratios to be looked into while evaluating banking stocks? So banking are a bit different from the fundamental analysis what we do to the other industries. Some of the key ratios which we'll be looking into is the CASA ratio, the capital adequacy ratio, non-performing assets, which is we also call it as NPA, provisions, net interest margin, efficiency ratio, and rate return on equity. So just to give you an overview of some of the ratios, CASA ratio is nothing but the ratio of current account to saving account. So current account, if the deposits are more in the current account, the bank will have free money to lend it. So that is the advantage. So higher the current ratio, the better for the bank. Coming to capital adequacy ratio, it is the measure of amount of capital the bank has relative to its risk-weighted assets. So higher the ratio, the better. Then it's the non-performing assets. So basically, it measures the percentage of bank loans that are classified as non-performing assets. So where they might be in default of the loans, so that we term it as non-performing asset. Again, there are two types. I'm not taking into deep. So we'll go on to the next ratio, which is the provisions. So it is the part of amount which is kept aside from the net profit of the bank to service these NPAs. So in case of any NPAs, the provisions will help as a buffer. Then the next ratio would be net interest margin. This is the difference between interest earned and interest paid on the deposits. The difference between these two would be the profitability for the banks, and the higher the profits, the better is the bank's profitability. Coming to the last one for the day, we'll be looking into the return on equity. That actually measures the profitability of the company's profitability relative to its shareholders' equity. Again, higher the better. Coming to the next question. So it's how do we identify cyclical stocks? Cyclical stocks usually follow business cycles. There are many types of stocks or many themes of investing, rather, I would say, such as defensive, growth oriented, dividend yield, etc. But coming to cyclical perform good on economic uptrends. Basically, when the economy is booming up, these stocks tend to rally. And when there is a downturn in the economy, like recession or inflationary environment, these stocks tend to fall. So basically, these are affected by recessions and global scenarios. So coming to the characteristics, some of the characteristics of the cyclical stocks, they are sensitive to economic condition, which I already explained you, and they are highly volatile and fluctuations. So there will be huge volatility in the share prices as well. And also beta is greater than 1, which is a part of the characteristic of this. And also we term this as high risk and high return. So we should always be careful that the entry is also important and exit of the stock is also very much important in these kind of cyclical stocks. Some of the sectors which we call it as cyclical is the real estate sector, consumer cyclicals, financial service, basic materials, and construction. So these are some of the sectors which are termed as cyclical, and these are high risk and high return companies and stocks. So I think that's it from my side. So I'll be handing over the mic to Mr. Chetan for the next set of questions. Thank you.
Thank you, Sridhar, for your inputs. We will continue our question answer. But before continue, I would like to request all of the participants to please put down your questions in the questionnaire box below. So we will answer that in our this webinar. After that, we will be having polls also. So I request all of you to attend that poll also. That would be really helpful for us. So yeah, so we will start off with the questions. We'll start off with my sets of questions. So as Ganga explained, her financial planning questions, and Sridhar has mentioned the research kind of question. I will be handling the questions which are common and which we have got it from our clients actually. So the first question: what are the possible asset classes that retail individual can invest in? Okay, so there are different type of asset classes, I would say, where an individual can invest in. Starting off with the retail, starting off with the individual who is a resident Indian or an NRI. So there is a limited option for NRI who is not residing in India, but the person who is residing in India, they have a lot of options to invest into. First of all, we have cash and cash equivalents. So cash is basically those banks account, savings funds. I would say there are multiple small, like T-bills. So those are the cash and cash equivalents where the individual can invest in. They provide low return and low risk also. So those are the good products for an individual. There are fixed income securities. Fixed income securities generally like bonds, government bonds, corporate bonds. So those kind of bonds are also available for a retail individual to focus on. They provide a medium kind of risk and medium kind of return. There are several, bonds into the markets where investor can look into. They provide returns in the range of, I would say, better than FD returns, but a range of 8 to 9 to 10%. After that, we have equity stocks. So equity stocks, we all know those are traded, publicly traded companies where an individual can invest in via broker or directly himself. There are multiple direct discounted brokers out there in the markets, so that can give, I would say, access to the equity stocks market where an individual can focus on. Real estate. So real estate, as normal, I would say, there are like real estate option. Normal commercial places, I would say houses, so where that person can invest in. There are multiple financial real estates also, like REITs, InvITs. So those option person can look into. Those are thematic kind of instrument, and it's very early stage in Indian markets, so a person can invest into and look into those states for the purpose of diversification. Commodities business, again, it's a very, as I said, it's very early stage in our Indian markets. So commodities are like gold, silver, cotton, crude oil. So those are the traded thing which person can trade and invest them as a hedge or as a diversification in their portfolio. That's the option. And lastly is the alternative investments. So alternative are different, like AIF or PMS, and some government kind of instrument. There's an alternative altogether. So that's I would say 6 asset class where an individual can invest in and diversify accordingly. But before investing into all this asset class, first one should have their own set of knowledge that how much risk they can take, what are their goals, and they should consult a financial advisor before investing into this asset class. So it's very important, as I mentioned in the note also, before investing in asset class, there is some kind of risk involved in that. So it's better to ask or take the advice of your financial advisor into that. Yeah. So moving on to the next question, what constitutes an ideal portfolio? So there are many, I would say, portfolio. It's a relative topic actually. So the ideal portfolio is the one that is tailored to an individual specific financial goal, their risk tolerance, their overall financial situation. Okay. As we are speaking, and a person who is just started investing and a person who is in their early retirement age, their both portfolio would be different, right? Their asset allocation class and their asset, I would say, in which they have invested. So all these things would be different. But there are, I would say, principles, basic principle which we follow before investing into, before creating any portfolio. So those, I would say, principles are same, whether it's a early guy who started investing or a person who is into his 40s or 50s or is into his retirement. So these are the principles. First of all, I'm sorry for that. So first of all, it should be well diversified, right? So concentration should not be there in his or her portfolio. This thing we check, and a person should not have more than 10 to 12% of any asset class or any, I would say, any stock or any company in its portfolio. So first of all, it should be very diversified, right? Secondly, it should not just be for the returns purpose. If a person is investing, of course he would be wanting to get higher returns from the market or a better returns. But the thing is, it should be aligned with your objective also. So first of all, you have to define your goals, and according to them you have to invest, whether it's short term, medium term, or long term, right? So it should be aligned with individual investment objective. It should be risk optimized also. So let's say you have a goal for 5 or 6 or 10 years, you should not be putting all of your money into the equity funds, okay, on the equity market, just for the example. So it should be risk optimized. It should have a proper allocation in debt and equity or gold, like that. So it should be risk optimized, risk averse, I would say. After that, it should be properly regulated and rebalanced. So investing is one thing, and monitoring and balancing it on a periodical basis is the second thing. Both the part is very crucial and very interrelated, I would say. So it should be regularly reviewed. In our Dilzer consultants, we review all of our portfolio internally in every quarterly basis, and with the clients on 6 month basis. So it should be regularly reviewed and rebalanced on a periodical time. In between that also, if there is some changes are needed, it should be done into the portfolio. Yeah, so lastly is properly researched asset. There are multiple, I would say hundreds and thousands of asset class out there. So it should be properly researched, and it should be help with an individual person who is expert in those asset class. So it is generally recommended to seek the advice of financial professional before creating any portfolio or recommending any asset class, so that it's better for you in the longer term and it should not hurt you. Yes. Moving on to the next question, what are ELSS fund? So this is a very, I would say, common question we get all the time. And as the March is approaching, most people are looking for tax saving option, right? And ELSS are the best asset class, I would say, in that overall tax savings things. ELS is generally known as equity linked saving schemes, right? Most of the people know that they can invest into up to 1.5 lakh and they can save their taxes in a financial year. So they are basically a mutual fund, right? They invest into a diversified portfolio of equity, but here the catch is they are structured in such a way that it get tax benefit under ATC, under income tax of India. So whatever you save in ELSS in a financial year, it will be up to 1.5. It will be tax saved. Okay, one should know that before investing into ELSS, there is a lock-in of 3 years. Okay, before that, there would be penalties. Okay, ELSS, it's very much beneficial if you invest into ELSS, and it's for 3 years, right? So fund manager has the flexibility to change the portfolio according to the markets and everything, and it does not have a pressure of redemption basically. So that way it performs really well. We have seen in past also that if you see a 5 year or 8 year, 10 year returns of this ELSS funds, if you invest consistently without any changing in the funds, they give really good returns over a long period of time. So ELSs are a product where they invest into markets, and they are very much efficient for an individual person. Yeah, moving on to I would say next question. What are the some key parameters in selecting domestic equity mutual funds? Okay, so this question is really good. First of all, I would say there are multiple parameters in selecting any equity mutual funds. We have our in-house research team who do in-depth research of mutual funds. Basically, there are more than 4,000 mutual fund schemes out there. From there, we selected I would say top mutual fund in its category. So how do we select? What are the parameters we generally take? So I'm going to explain you the broad parameters what we select for any individual. Okay, first of all, starting with the investment objective and strategy, right? So the investment objective and strategy is like the base of any investment. Why the fund is created, what's their objective and what's their strategy. Is their strategy proven in the longer time frame, if that has seen bull market, bear market, both. So this is the first and base thing what we look into selecting any mutual fund. Secondly, past performance and risk. So this is a crucial point. So past performance generally does not indicate how much it will perform in the coming years. But the past performance we look whether in the bull run or bear run, how much it has performed compared to the market. So in market we generally compare it with the benchmarks, whether it's schemes, ETF, whatever it is. We have to check with compared to the overall market, how does the scheme or the fund manager has performed, right? Risk part is also a very big what we look into. So risk generally means market risk, systematic risk, unsystematic risk, okay, concentration risk. There are multiple risk factors which conclude into this one, standard deviations and all those things. So that is a very crucial point what we look into. Third point is expense ratio. So what we believe is for our clients and for anyone who is investing into mutual funds, your expense towards mutual fund should be lower, so that your overall returns after fees and after expenses should be higher, right? In a long run, it's make very much sense to invest into lower expense ratio mutual funds. So we generally recommend to invest into index kinds of fund, and funds those who has very like justified risk adjusted return. They have justified. So in that only we select basically. Direct mutual funds and regular mutual fund. In expense ratio, there are two categories. I would say direct and regular. In direct, what generally happens is your expense toward mutual fund is lower, okay, and we don't get any commission. So as a SEBI RIA, we don't get any commission from the direct mutual funds itself, okay. So we charge a fees to the clients, right? In regular mutual fund, we get commission from the mutual fund company itself, and for client, it's the expense toward mutual fund is higher. So that's a regular mutual fund. Okay, a client has flexibility to choose both of the things, okay, whichever is beneficial for them. Okay, if the portfolio is, it depends upon the portfolio and goals, everything. So based on that, we explain, whichever is flexible and for them, we help them, diversification. So as from the last 2 or 3 questions I mentioned, diversification is a very crucial point in selecting any mutual fund. So that what we see if the fund is properly diversified or not. Portfolio turnover ratio, it's a very I would say small point which most of the people overlook. Turnover generally means how much they have bought and sold in a financial year compared to the other category funds. Okay, if the turnover is high, which means the cost is also high, and if the cost is high, the returns are lower. It's a simple this thing. So we choose the funds who has a portfolio turnover ratio very low. So that is fifth point what we choose. And lastly is fund manager. So everything is dependent upon he has to take whatever buying and selling and managing the funds. So fund manager is very crucial. We select fund manager who has decades of experience in the markets, who are trustable, who are reliable. So we select those fund manager itself. So these are the top 6, I would say, parameters we choose before investing into any mutual fund, and we recommend to any of the client. So these are the broad parameters, I would say. If you want to know are the different key parameters in depth, you can mail us, or you can call us. Basically, we would be happy to explain you over the call and everything. To the next question. Yes. Yeah, I'm sorry. There is some issue with screen sharing. Should be up. Okay, just for a second, the screen would be on your screen. Yes. So I think you are able to see the screen. Okay, so the question is, where do NPS invest? So the NPS National Pension Scheme, as explained by Ganga, it's a retirement savings schemes in India that allowed individual to contribute a portion of their income towards their retirement. Simple as that. Most people, so it's a retail product altogether, right? It's a long-term product and especially designed for the retirement for an individual, right? The NPS is managed by the PFRDA, which is a board for pension scheme. So its name is Pension Fund Regulatory and Development Authority, right? Just like we have SEBI for equity markets, and we have MFI for mutual fund markets, PFRDA is for NPS and retail products, and it's offered through various point of presence, which means POP banks actually, such as banks and financial institution, where you can go and open your NPS account. The NPS offered two instruments, two type of saving option. First is Tier 1 and Tier 2 account. Tier 1 account is mandatory, as we all know, and designed for long-term savings and cannot be withdrawn until retirement. On the other hand, Tier 2 account is a voluntary account that allows more flexibility in terms of contribution and withdrawals. NPS investments are allocated to various asset class such as equity, government securities, corporate bonds, alternative investments, and others. So equity. So as I have explained, equities itself. So equities are publicly traded listed companies where they invest into. They have option to invest. Government securities such as government bond, treasury bills, T bills. And most of the government products which they issue is time to time. Corporate bonds. So corporate the companies which has to raise the capital from the market itself. So they issue the bonds. Okay, these are the companies. So that's known as corporate bonds. Alternative investments such as real estate, infrastructure, commodities. So those are the product where the allocation is lower in the alternative investments, but there is allocation. NPS investment is managed with professional fund manager. So there is a person who will handle your, all the capital which you have invested, and are allocated to different asset class based on investment options chosen by the investor, which means you. It is important to carefully consider your investment objective, risk tolerance, financial situation before investing in NPS. It may be helpful to seek the advice of a financial professional. So that was, where do the NPS invest into, and the broad, I would say, NPS explanation. Now let's start with some questions. I have a couple of questions with me. So first of all, it's a really good question. Do you have PMS? Are your past? What is the minimum investment needed? Okay, so it's a really good question. Okay, so the same question, do you have the PMS? What is the minimum investment needed? How is the performance of your current PMS? So actually we don't have our own PMS. Okay, we actually select the PMS which is out there. So there are, I would say, multiple PMS houses in the recent years, last 4 or 5 years. Multiple PMS has been opened, right? There are lot and lots of options. So what we do is we select, the best of the schemes, best of the PMS out there, portfolio management schemes, what we call them, for the clients. Okay, the minimum investment needed, earlier it was 25 lakh, now it's 50 lakh. Okay, so a client should have 50 lakh investment to invest into PMS, and they will invest generally into the equity markets itself directly. Okay, on behalf of an investor. There are multiple, I would say, PMS houses we select, and we, suggest it for you. We don't have any PMS as of now. Past return, I would say, it's depend upon the PMS, strategy, and the fund manager itself. There are multiple PMS who have outperformed the benchmark. Benchmark is Nifty and Sensex. There are some PMS who have just recently introduced or recently opened. They do not have track record, but the strategies are, very much convincible, and very much, according to our framework actually. So that's a broad thing about PMS. On, we help clients to suggest the PMS, and we help them to, invest into PMS. Yeah. Any more questions? If anyone has. Okay, so one more questions we have. So that is, what is Sharia investments? Okay, so this is a very important questions we have got. Sharia, how do we invest to Sharia? The question needs to ask. So I would say this concept has been, very much famous in most of the Arabic, I would say, Middle Eastern countries, where people want to invest, but the thing is, they do not want to have interest income. Okay, because it's forbidden in the Sharia law. Okay, as I would say, the most of the NRIs is looking towards, India to invest in. The Sharia law is very much getting popularized in the last, I would say, couple of years. Let me give you some broad points. What is Sharia law, and how we can invest according to it. So Sharia law is, I would say, basically a law based on, Islamic thought, right? Their main objective is to, invest, but not to harm the environment. Okay, for and and to maintain the, good for the society, whether it's, environment or everything. So their main objective is that, right? But there are, I would say, broad points where we have to look. So they cannot invest in any companies who is, involved in gambling, trading, I would say, making cigarettes, liquor, or, anything which is harmful for the society and environment. So that is the first point I would say. They cannot invest into, those companies who have. Okay, so that's a good question. Which sector I would take that question first? Which sectors are currently attractive in terms of valuation? We have our research person Sridhar with us. He will answer this question. So, yeah, Sridhar, please.
Yeah. So, which sectors are currently attractive in terms of valuation? So, as per the current scenario, the sector, the IT and pharma has been corrected very aggressively, and there might be a recovery in these sectors. So it's a good time to accumulate some of the funds into these mutual funds or stocks of IT and this one. And as per the sector rotation, if you look into the FI data, so there has been a excessive selling in last 1 year in the IT and pharma sector, and the inflows have gone into the automotive and fast-moving consumer products, consumer goods. So that's where FIIs are investing. And now, as a contract thinking, if we could accumulate some of the stocks of mutual funds in terms of pharma and IT,